LiteFinance, the world of financial freedom.
Hello guys, it's Monday, October 10th, and naturally it's time to start the market forecast. So we'll go through the macro calendar, and after that we will dive deeper into analysis of CAD and Euro USD. So let's begin. Okay, so Monday seems like it is going to be a slightly more lazy start than usual. There are no major data publications. So when we go to Tuesday, we see data from Great Britain on the calendar, namely claimant count change and average earnings, and that's basically it for Tuesday. Next is Wednesday with the GDP and manufacturing production figures, again from the UK, later inflation data on producer side, the PPI, from US, and in the evening FOMC meeting minutes. So Wednesday can be an appetizer before Thursday, when we will get inflation data first from Germany and later, most importantly, from the US, which can cause another wave of US dollar appreciation on the market if they turn out to be worse than previous one, namely a reading will be higher than the last one. And as we learned last time, we need to focus on CPI and core CPI as well. Last reading was a surprise, since core CPI was gradually falling for a longer period of time, which meant that supply chains were slowly repairing, and then suddenly it turned out that the reading was much worse than previous one, which means the end of inflation is not on the horizon yet. So Thursday will be the most important day of the week for sure. Apart from CPI data, still that day we will get crude oil inventories. And on the last day of the week, we will get inflation data from China and retail sales from the US. So now we move on to discuss the CAD, since unlike the Reserve Bank of Australia, the BOC is not going to slow down monetary restrictions and is ready to raise rates even higher. According to the Canadian regulator, only this approach will help avoid recession. Stopping now would require a monetary tightening in the worst of conditions, which will hit the Canadian economy more, they said. At first glance, the central bank's hawkish stance coupled with the rising oil prices creates favorable conditions for the loonie. Indeed, as currency of an oil exporting country, it should have been optimistic about OPEC Plus plans to cut production by 2 million barrels per day, and the ceiling on Russian oil prices, and Goldman Sachs and Morgan Stanley forecasts of Brent prices rising above $100 per barrel by the end of the year. And yet, this is not enough for a serious USD CAD correction. The US dollar is stronger than ever, the 20-year high zone and the oversold USD don't matter. So when the energy crisis in Europe imposes kind of a taboo on purchases of European currencies, and the Fed is not going to suspend the increase in the federal funds rate, it is too early to expect the greenback to lose its high status. So the continued rally in treasury yields and the fall in US stock indices will push the USD even higher. In the short term, the September US and Canadian jobs report can affect the dynamics of USD CAD. It didn't happen initially, but we might see some stronger movement in the market open. But overall, it is unlikely that one report will force the Fed to change its outlook. What we can count on now is a correction at early market open that could allow us to enter longs with a target at 1.40. So now we go to the Euro USD. And so the IMF, which is about to cut the forecast for the global GDP growth, suggests increased downside risks. According to the organization, the global economy is like a ship in a storm. It has gone through shock after shock over the years, and the situation will hardly improve soon. Instead, it will worsen due to problems with the Chinese housing market, sovereign debt, and illiquid assets. Global GDP is likely to contract for at least 2 quarters in 2023. So, what should investors do amid the market storm? We could monitor economic data. Never since the 1990s have financial markets reacted so sensitively to US domestic data. The markets are operating in the bad news from the US economy is good for the market mode, as despite all the failures, they continue to believe in the Fed's dovish shift. A typical example is the reaction of stock indices to US PMI report. But of course, the key indicator is inflation, and judging by the speeches of the FOMC officials, the Fed is far from reaching its inflation target, so the best solution is to stick to the strategy of short-term purchases followed by medium-term sales. Okay, I think that will be all from my side. Thank you for watching and till next time.